Hey guys, Jeff Kamke with Wealth Energetics. In this video, we're going to talk about a recent lawsuit in the insurance industry that you need to know about. If you're planning for retirement, you're thinking about retirement, you're at the retirement age, and you're looking at where do you put your money? What are some ways that you can get ahead? What's the best way for your money to be working for you towards retirement, already in retirement? You might have heard of Indexed Universal Life or IUL, and there's some things that you need to know about that if you're going to be thinking about using that as part of or maybe all of your retirement income because it's being pitched as this hack of the rich and this way to be taking money, putting it in this product that has no real potential for loss, it has only upside potential, and you're going to have all this tax-free retirement income. Those are probably the key words. I actually had a client text me a week or so ago asking for a few things from his current whole life policy, and he said that he wants to look at income in retirement, tax-free retirement income. So likely he's being pitched an IUL. So these are things that you need to be aware of as you're planning for and thinking about or already in retirement about this product and whether it's a good fit for you or not. So let's dive into a little bit about Kyle Busch's case because he's a NASCAR driver. Him and his wife 7 years ago had put over $10 million in that span of time into this indexed universal life product. It was Pacific Life insurance company that had done this and the agent that did it for him. And in that span of time, this policy lost over $8 million. And so you wonder, how did it do that if indexed universal life is supposed to have downside protection, meaning you can't lose money if you hear the people that are pushing for IUL, the salespeople, you watch the TikToks or see the ads as I do in my Facebook feed, that you can't lose money in an IUL. It's impossible. Well, it did here. So we're going to shed a little bit of light on how that happened, why that happened, and just the inherent nature of IUL and seeing if it's a good fit for you and is part of your retirement strategy. So with Kyle Busch and his wife, there was actually a couple different policies involved. But the one that was the main focus, of course, was and maybe even collectively was over almost $8.5 million of loss. And so what caused that big of a loss? Because that is a substantial amount of money to lose 80% of your value. So there's a great article from Bobby Samuelson. He's one of the industry experts that life insurance companies use him for product design. And he's just that like wizard, that sage person. If you ever, I think of the movie Frozen when they go and get all the little gnomes or whatever that are rocks, they turn into the little experts. I think of him as this person where he just knows so much on the life insurance side. And a great article that he talked about breaking this all down and where were the deficiencies? Is it a deficiency that all life insurance is bad? No, it's not. Is it a deficiency that all index universal life products are bad? No, it's not. Is it a thing where all Pacific Life products are bad? No, not necessarily. So where does it come down to? Well, in Bobby's article, which is a great lengthy article going into very detail about this particular case and what made it up, it ultimately came back to a lot of it was the agent. I personally put some on the life insurance company for allowing an agent to design a product like this and actually allowing it to go in force. So to me, both parties are involved, but a lot of it came down to the agent got a little greedy in how they designed this indexed universal life policy because there's different ways to design pretty much all life insurance. You can customize a lot of different aspects of the policy. And with indexed universal life, there's a lot of moving levers with it. You can control the funding and how much you're funding it. You can control the death benefit, how that's calculated. And there's just other things that play into indexed universal life that we'll probably get into in this video that you'll need to know about so you're making a good decision for you. So that's what this really came down to was the agent made this a mostly, if not all base policy, meaning there was very little cash value on that, which boosted his commission considerably. So that is the first red flag. This can happen with whole life. This can happen with indexed universal life. It can happen really with any cash value type of a permanent life insurance product where the agent can change things that might be more in favor of themselves and not so much the client and not in alignment with meeting the goals of the client and what's best for the client, but better for their commission. And so that's something you need to be educated about if you're ever looking at some sort of life insurance, whether it's whole life, indexed universal life, variable universal life, any of those types of products, making sure that you know for certain that the agent is doing things the best way, which usually means more cash value, less base part of the policy, so that they're getting the agent is getting paid on the base. The highest commissionable percentage is on the base, not on the cash value. So if you know that it's a maybe 50-50 split between cash value and base, you know that that agent's commission got cut relatively about in half of if you were to sell an all base policy. And that's what happened with Kyle Busch was the agent sold him virtually very little cash value, and it ate itself alive. So you might be asking, how did it eat itself alive? How does a product that is advertised and market that you can't lose value in this? How did it lose 80% of its value roughly? Well, with indexed universal life, you have to understand that it's not like whole life insurance. It's actually built on the chassis of annual renewable term. And so with that meaning that every year you get older, your cost of insurance goes up because you're statistically closer to your mortality. So the insurance company is going to charge a little bit more because there's a higher and higher likelihood that you're going to pass away. So over a number of years, the cost of insurance continues to go up. Now, that alone does not mean that a policy is going to lapse or be in potential of lapsing, but it does come into play with how this policy was designed, where there was not enough extra cash value in the policy to take care of the fees and lower the death benefit, because this was an all-base policy. Most of it was going to pay for death benefit, which I think was like a 30 or $40 million death benefit with this policy, which is a very high cash value, or excuse me, high death benefit, which with somebody of Kyle Busch's stature, of course, you need that. He's a race car driver. There's a chance of him, being killed. And of course, he's built an empire around NASCAR and probably other ventures that he's doing. And like a lot of celebrities and athletes tend to do, they have a business empire that continues to scale beyond what they've made in the sport that they're playing. So that was the case with Kyle. So this policy was so high in death benefit, very little cash value. And so when those policy fees start coming out year after year, it really can eat into the way that this policy is structured and diminish the overall cash value of the policy. And one of the big key factors that Bobby Samuelson in his article pointed out was the fact that not only was the cash value low, but the way that the cash value was where it was growing was in a fixed account for the first few years, which is only getting a little over 2%. So it wasn't capturing the upside of the index, whichever index this product was mirroring. Even with an index product inside of an indexed universal life, there's going to be a cap on that. So that may be at 8%, 10%, 12%, 16%, just depends on when it was put in place. Now, this particular one was done before some insurance regulations had been done, AG 49, AG 49A, AG 49B. So this product was likely allowed legally. It shouldn't have been done, but they could have potentially allowed it in an illustration to show Kyle Busch that he could have been getting 12, 14, 16% on this indexed universal life, but instead they had it allocated into a fixed account. So his cash value was growing very slowly. In the years that he had that policy, the S&P 500, there was double-digit returns, I think 4 out of the 6 years or 5 out of 7, whatever those years lined up to be. So that policy was not able to really add to the cash value. So those factors all put together is why this policy was in danger. So you need to know that, because you can't make the assumption because you saw a headline in Yahoo Finance, like what's right here, that all insurance is bad, all life insurance is bad, all whole life is bad, all indexed universal life is bad. You have to understand why this happened and then learn for your own situation so that you can be informed, taking responsibility over your own process, and make sure that you're finding an agent that aligns with the best knowledge and has the best strategies and understands where the dangers lie in. Because I can tell you for a fact, the people that I know in this industry, I've got many friends in this industry, many colleagues in this industry, and we all talk to people all the time that just think one thing about indexed universal life, that it's this amazing product and you can't lose money and it's just this hack of the rich. And none of those people that we hear have been told the downsides, the potential risks, the things that are the other side of the discussion, to be an educated consumer in what is going on with a policy. So because that's a void in our industry where everybody's only talking about the benefits and the positives and you're going to make so much money, there is a severe deficiency in this. And so this is why I want to do this video to educate you on what you need to know around not only this case with Kyle Busch and his lawsuit, but just making good informed decisions about this product, why you would use it, and is it a good fit for you? So let's dive into that a little bit deeper. So you have life insurance, right? Life insurance, most people think it's for death benefit, right? It's for burial coverage, it's for death benefit if a spouse or someone loses their job and dies, or dies and obviously loses their job, loses the income, then that death benefit is there to replenish the income that that person would be making. So if you listen to people like Dave Ramsey, he says a minimum of 10 to 12 times your income you should have in death benefit. He obviously recommends term life insurance. A lot of insurance companies, they recommend a minimum of 20 to 25 times your income in life insurance based on your age and a few other factors. So knowing that that is the critical piece, that's what most people assume. That's what most people focus on. And most people think, I don't need that. But little do they know that life insurance is actually a foundational asset in your portfolio. And here's a few reasons why. It's the most flexible asset that you have the most control over. You have the ability for that tool to go with you literally all through life, make everything you're doing financially more efficient, take care of risks that you really can't otherwise without buying other separate tools out there in finance, whereas life insurance does it all under one roof. So, what are some of those things? Well, it can be if you own a business, it can be a source of capital. It can be a source of your own banking system where you're not going to outside lenders to buy equipment or different things with your business. And you control the capital. You control the flow of money. That's a powerful thing. You might have heard of the infinite banking concept. That's what this is alluding to, is you being your own bank, utilizing life insurance, whole life, permanent dividend paying whole life insurance as that foundation to do that. Other things that life insurance can do, particularly the whole life side can do, is it allows your investments in retirement to last longer and be more efficient. It can also be for living benefits, which does not get talked about a whole lot in the life insurance space. So that means if you are critically, chronically, or terminally ill, you get an advance of your death benefit to use towards your care. So that plays as like in a way up to a point like long-term care. If you can't afford long-term care, but you have living benefits on a whole life policy, and you can get living benefits on other types of life insurance as well, but mainly I'm focusing on the whole life here in this discussion. That is a powerful piece. I speak to people all the time that legacy, leaving their children and grandchildren money, or leaving a cause that is near and dear to their heart, leaving that money as well. And life insurance is the best, most efficient way to leave typically more than $1 than what you've put in to your heirs or to that cause. So if you have $1 million death or $1 million of cash value over the life of your life insurance contract, likely more than $1 million is going to go to the next generation tax free. There's no other method of transferring wealth like that. Without incurring taxation and potentially other penalties or situations that your state may come in and have like estate taxes and things like that. So those are some of the things that it provides. So then you're looking at, why do I need life insurance? What is the goal that life insurance could fill? So you might have heard, and this is very popular in the index universal life space, that insurance is an investment. Life insurance is an investment. And you hear people like Dave Ramsey and other talking heads try to compare life insurance and investments, a lot of times whole life and investments, and trying to make them out to be apples to apples when they are two totally separate things. You should be having both in your portfolio. And if you're talking to somebody that doesn't understand why you should have money invested into things that are aligned for you, and you should be having whole life as a foundational asset, a place to put capital, as a savings alternative, as a bond alternative, as the things I've already outlined. It can be used for college, an alternative to college planning, or supplement to 529s in college. It's just the most flexible asset out there. And so if you have somebody trying to compare the two, and they're always going to focus on rate of return, they're going to say, but you can put money in an index fund in the S&P 500 and you're going to average 10 to 12% every single year. Why in the world would you put money into whole life or other types of life insurance when you're just going to be money behind? You're losing money. Well, and that's because not everything comes down to rate of return. There's other factors. There's the taxation, there's control, there's flexibility, there's asset protection, there's other variables that are kind of invisible when you're thinking about whole life insurance and other types of life insurance that don't come right out as a direct benefit monetarily. It's not as easy to see as rate of return, but there are a lot of things going on that actually make it way more valuable than what it appears to be. So you need to understand the best financial planning includes both tools and knows how and when to use them to leverage the power of them together instead of having it be a fight against apples and oranges and saying you should have one over the other and life insurance is bad. No, the very wealthy families in this country, they have lots and lots of whole life insurance. Entrepreneurs have life insurance. And as I've been working with a number of clients for a number of years at planning, nobody is taking account, even their advisors are not taking account for the 5 to 8 risks that most people encounter as they're planning for and in retirement. And whole life can actually take care of the majority, if not all, 5 to 8 risks in retirement, something your stock market portfolio cannot do. So those are things that you need to be aware of. Now, I've got videos on this channel talking about the other risks in retirement. You're going to want to check out that video. I outline those. I think it's about a 15-20 minute video where I outline all those risks in retirement that you need to be thinking of, preparing for, and having a plan for. If you're meeting with your advisor or if you have an insurance specialist that you're working with, making sure you have a plan and you're knowledgeable of what those risks are and you know how to take action and set up a strategy that allows you to be confident in your plan moving into retirement. So you don't get into a situation in retirement when you're like, oh crap, I didn't even think this could happen. It happened. I'm in the middle of it. I have nothing, no way of navigating this, no plan, no way to execute it. And there you are. You're just stuck. And you got to figure it out in that moment. Can I tickle it? That's So those are things that you want to make sure of when you get into the retirement phase. So when we're talking about life insurance, you need to ask some questions about, is this the right product for me? Is this the right tool for me? So as you're leading into retirement, more than likely, you're like most people, you've put most of your money in the market. So that's usually between an IRA, Roths, 401ks, or the other similar things, depending on your profession, whether it's a TSP, a 403b, or whatever. And you've got the money there, but likely you haven't accounted for the other side of the risk safe balance that you should ideally be having in your portfolio and the risks that I just mentioned. So for if you're like most people and you're thinking of retirement, you're wanting to plan ahead for retirement, or you're very close to retirement, or you're already in retirement, you're going to want to be thinking of what risks have I not handled? What are my goals in retirement? Do I have enough money put away? What's the most efficient way to draw income from that retirement? And those are the basis of what you should be planning forward. So does indexed universal life fit into that? I find for most people, they're already over leveraged in the market, and a lot of people are not doing with their money what they say they want to be doing with their money. They say they want to be more conservative, but they got, maybe 60, 70, 80% of their money tied to the market. So if that's the case, adding indexed universal life, which is tied to an index in a way through an option strategy, you're adding more to the risk side. You're not doing anything to offset that on the bond side or the more safe and conservative side. So if you're somebody that sees that in your own portfolio, likely IUL is not a good fit because it's probably counter to what you're wanting to do. And especially as you get closer to retirement, most people want to start dialing down the amount of risk they're taking and where they have their money allocated and start shifting and transitioning money over to the safe side, out of the risk side, because you don't need to be growing it as much necessarily. You need to be thinking more safety, security, and that's where whole life comes in. That's where annuities can come in as a portion of your portfolio to start locking money away and having consistent cash flow that's at a guaranteed level out of annuities, and then have a buffer with whole life. And then you have still money that's tied to the market that can grow. And that is the ideal, basically portfolio for you to have in a certain ratio, right? Now, you obviously need to talk to somebody in more specificity about what that looks like for you, but you need to be, as the client, educated on what this ideally should look like and asking the right questions and knowing yourself and your situation well enough so you know that whether a product is aligned to what you're trying to accomplish or misaligned, because there's a lot of marketing, there's a lot of deceptive tactics out there used around this stuff. And if you're getting one size fits all advice, I say this in other videos, if you're getting one size fits all advice, like buy term and invest the difference is the only way to go, or everybody should have annuities and you should have most of your money in annuities, or you should have money in whole life and don't have any money in the market, or whatever the flavor is, right? You probably should run from those people and probably, plug your ears and go the different direction, because that person does not have a holistic view. Their training is very limited. Their training is very singular focused, and there's probably a lot of bias built into what they have learned and experienced, and they don't have a well-rounded education around different tools, how they are used together, the overall strategy that you can put different products together and amplify their results and leverage them against each other for the benefit of the client. So those are all aspects you need to be thinking about when you're talking about looking at something for retirement. And should you use something like indexed universal life? Because of like how Kyle Busch was pitched this, was it's tax-free retirement. And a lot of times they will be pitching you the growth inside of these funds are going to just give you so much tax-free income in retirement. Now, life insurance is not retirement income. That's not the design and the purpose of them. So if you're being pitched that, you know that you're being used or you're being pitched a product that's being used outside of what it's meant for. And that there is inherent to having extra dangers, extra risks inside of it, because life insurance is not meant for tax-free retirement income. That's not its purpose. Now, it can be supplemental, but if that's the sole strategy, that's where you're going to get all your money in retirement, that's not what life insurance is for. That's certainly not what indexed universal life insurance is for. Now, can it be supplemental above and beyond Social Security? Can it be part of an overall plan? Certainly it can, but it should not be a large percentage of what you're trying to accomplish in retirement planning through something like an indexed universal life or even through whole life, because I know there's some whole life advisors out there that will try to say the same thing. You're getting uninterrupted compounded growth and you can use this as tax-free retirement. I've heard it. I've had mentors teach that to me as well before I learned better that that's not the best way to go about it. Life insurance is better used where it's strongest, not trying to produce income. That's not its strength. So because that's the case, you just really got to think about what you're doing, asking the right questions, and hopefully I gave you some perspectives in this video that will help you form a good perception around not only your own situation, but when you hear headlines like these about something that happened, you are going to be able to go, oh, that doesn't mean all life insurance is bad. That doesn't mean all index universal life is bad. I just need to know why that happened, number one, like I've outlined here. And then number two, you need to be working with somebody that can align and get clarity around who you are, where you're trying to go, what you're trying to accomplish, and make sure that they're putting in place the right strategy with the right products and tools financially to help you accomplish what you're doing, that you feel good about, that you feel aligned with, and you've done enough due diligence to know pros and cons, and you've asked around, you've shopped around, and you know for certain that this is a good plan that's going to carry you forward. So if that is you, if you need help in this area, you maybe don't have much education around retirement planning, you don't have much help, you just been putting money away because that's what everybody does, and you want to know if you're on track for retirement, you want to know if you've handled the 5 to 8 risks in retirement as they come up throughout those retirement years, whether it's pre-retirement or into retirement, or you just want some advice on products and things, click the link in my bio, schedule a strategy session with me, and be happy to talk over where you're at, get to know you, what your situation is, where you're trying to go, and see what we can put in place for a strategy that feels good for you. So if you have any questions or comments on this topic or Kyle's Busch case in particular, leave them in the comments below. Be happy to answer any of those. And with that, you guys take care, and we'll talk to you in the next video. Bye.